Hey everyone, and welcome back to The Explainer. Let's just jump right in, shall we? If you've been following along, you know we've been deep in the trenches of the revenue and collection cycle. Well, today is a fun one. We're taking an exciting step, moving all that theoretical textbook knowledge directly into the real world. We're looking at the advisory framework. Think of this explainer as your essential bridge. It's what takes you from simply knowing the rules to actually sitting down and confidently advising a living, breathing business. In our last lesson, we tackled the theory, right? Controls, risks, and KPIs. You built a really solid understanding of what can go wrong in a cycle and exactly how to measure those vulnerabilities. But here's the real challenge when you transition from student to advisor. How do you actually apply this systematically when you're sitting across the table from a real-life client? I mean, it's one thing to know a risk exists on paper. Uncovering it in a messy, real-world business environment and actually fixing it, that is an entirely different skill. So here's our game plan for today. First, we'll go from theory to application. Second, we'll break down the 5-step advisory method. Third, we'll look at business model variations. And finally, we'll look ahead to some red flags. We're taking a highly structured approach today, so by the end of this, you're going to be able to tackle absolutely any client engagement with total confidence.
All right, Section 2, the 5-step advisory method. Basically, your new consulting playbook. Okay, so this is the core framework you're going to use day in and day out. Seriously, whether you're onboarding a brand new client, doing a routine process review, or crafting a super specific advisory recommendation, this sequence right here, it's your North Star. Step 1, understand the model. Step 2, map the flow. Step 3, identify gaps. Step 4, design controls. And Step 5, align KPIs. The logical flow here is absolutely everything. It is built entirely on cause and effect. Because if you rush ahead, like say trying to design controls before you've even mapped the flow, you are fundamentally going to break your advice later on. Your solutions just won't match their reality.
Which brings us to the cardinal rule of advisory. It's simple but crucial. Do not proceed to mapping without understanding the business model. Before you look at a single spreadsheet or system dashboard, you literally must uncover exactly how they make money. Do they sell physical products, professional services, or software subscriptions? Is the billing one-time, recurring, or usage-based? And who are their customers, B2B or B2C? The answers to these fundamental questions literally shape every single step that follows.
Once you've nailed down that model, we move to Step 2 to see how this all builds. Now you map the client's actual flow. You're going to walk through each of the standard 11 stages of the revenue cycle. But here's the kicker. You have to map the client's actual, messy reality, not what they wish their process looked like. You want to pinpoint exactly which systems are being used at each step. Like, is sales using a CRM while finance uses an ERP, a totally separate billing platform, and a disconnected bank feed? You need to confirm exactly who owns each stage. And, crucially, you've got to flag any stages that are missing, highly informal, or handled via manual data entry. Because, honestly, those manual handoffs, that's exactly where the cycle usually breaks.
Next up is Step 3, which is all about identifying control gaps. Now, I want you to treat this step as your rapid-fire mental checklist. It's your litmus test when interviewing a client. You're going to ask them, are approvals clearly in place? Are duties properly segregated between the person billing and the person collecting? Is delivery formally confirmed before that invoice goes out? Is cash applied promptly, or is it just sitting there unallocated? Is there a formal collection cadence? Listen really closely to their answers. Because every single time that client hesitates or answers no, well, you've just uncovered a critical control gap that needs your immediate attention.
And that brings us right to Steps 4 and 5. Step 4 is designing controls, and Step 5 is aligning KPIs. Now, for Step 4, when you recommend a control, whether it's a new approval workflow, a reconciliation report, whatever, it has to be realistic. What can this specific client actually implement given their current size, budget, and systems? A beautifully designed enterprise-grade control is completely useless to a 10-person startup, right? Then, in Step 5, you align the reporting. Define exactly what metrics get tracked, how often they're reviewed, and by whom. Because the ultimate goal here is client self-sufficiency. You want to empower them to monitor their own cycle without depending entirely on you for basic visibility.
Moving on to Section 3, Business Model Variations. Let's talk about adapting the playbook.
So let's take that universal 5-step playbook and adapt it to the specific client sitting in front of you. First up, let's look at a product business. Think wholesalers, retailers, manufacturers. Here's how their chronological flow runs. It starts with a quote, then a purchase order is received. Next comes the physical production or the warehouse pick, followed by a delivery note. Then the invoice is generated, and finally, payment. You can actually see how the movement of physical goods dictates the pace and the stages of this entire revenue cycle.
But physical goods bring specific, really severe risks. The biggest one? Delivery not being confirmed before the billing goes out. You might also see inventory mismatches or nasty customer disputes regarding the quantity or the condition of the goods when they arrive at the loading dock. Because of this, your focus as an advisor needs to point straight at the billing triggers. You absolutely must implement rock-solid delivery confirmation controls. You've got to make sure that nobody's getting invoiced for a pallet of goods that's still sitting on your client's warehouse floor.
Now let's contrast that physical flow with a service business flow. Think consulting firms, creative agencies, professional services. Notice the dramatic shift here. The cycle starts with a contract signed, moves to service delivered, then to a timesheet or a milestone sign-off. Only then does it go to invoice and finally payment. In this model, those timesheets and milestone sign-offs completely replace the physical delivery notes we saw in the product business. I mean, you aren't shipping a box on a truck anymore, you're delivering intangible expertise and time.
And because of that intangible nature, the dangers look totally different. We're talking scope creep, getting billed without formal client approval, revenue being recognized way too early before the client actually accepts the work, or subjective disputes over whether completion criteria were actually met. Your job as an advisor here is to lock down those milestone documentation policies. Your absolute focus has to be on revenue timing. You need to ensure the service is verifiably completed and signed off by the client before that invoice is ever generated.
Okay, let's move to a completely different beast: SaaS, software as a service, and subscription models. This model actually splits into two distinct operational streams. On one side, you've got the self-serve workflow. A user signs up on the website, they're auto-billed via a platform like Stripe, and if a payment fails, it triggers an automated dunning process to recover the funds. On the other side, you have sales-led. This is where a formal enterprise contract is signed and a complex billing schedule is configured in a system like Maxio or something similar. As an advisor, you really have to recognize that these are two very different paths living inside the exact same business.
And the cause and effect of SaaS risks? They are entirely unique to the tech stack. For example, let's say a customer service rep manually applies a credit but forgets to update the underlying payment links. Well, you're going to get an immediate cascade of failed payments. Other massive risks include deferred revenue timing errors, which, by the way, are an absolute nightmare in software accounting, and failed payments that just never get followed up on because the automated system quietly stopped trying. So your focus has to be heavily anchored in platform configuration. You need to get under the hood, into the settings of those billing platforms, and make sure those failed payment workflows are completely airtight.
Section 4. Looking ahead. Red flags. Let's see about putting the framework to the test.
So the absolutely crucial point we're walking away with today is this. You now have the playbook. You know the rigorous 5-step method. You understand exactly how the system flows, where the hidden risks lie, and how your advisory focus has to shift entirely depending on whether you're looking at a product, a service, or a subscription business. But here is the real test. You know the framework, sure, but can you spot when a client is actively hiding a broken process? Because sometimes the map they show you isn't the real territory. That provocative question is exactly what we're going to tackle in our next explainer, where we'll dive deep into real-world case studies and the critical red flags you need to watch out for. Thanks for joining me for this explainer. Keep applying this structured framework, and I'll see you in the next one as we put all this theory to the ultimate test